I am Susan Anastasiadis. I'm one of the co-founders of Capital Insight Partners. We're so thrilled to have you all here today, especially the folks from Foothills Asset Management. It's been a couple years since you joined us, and we haven't been able to have this event live, so it's great to see so many of your faces here today. We also are happy to have those of you that are viewing this presentation on video as well. Before we get started, we'd just like to ask that you please quiet your phones or turn them off as the presentation continues. Now, as we get started, I am going to be introducing you today to someone who we really are happy to have a part of our team, Steve Mahan, CFA. As most of you probably know, last year was a great year in the markets, and Steve has the pleasure to talk to you about how it went. So welcome, Steve Mahan.
Thank you, Susan. Thank all of you for joining us today. We're really excited to have you here. Hopefully you enjoy the next 30 minutes and you find a lot of the information that myself and my colleagues go over to be pretty useful to you. So as Susan mentioned, I'm going to give a recap of markets last year in 2021. 2021 was certainly an eventful year, a bit of a roller coaster year in terms of the headlines. We had everything from vaccine rollouts to COVID-19 variants, rising geopolitical tensions, and global supply chains that were kind of pushed to the brink. But despite all of that, the dual forces of continued economic stimulus and earnings recoveries among companies here in the United States led it to be a great year for U.S. stocks. I mean, the S&P 500 saw a record close 70 times last year, despite all that bad news and the big kind of wall of worry. When you look at the economy in 2021, go back to 2020. In about April of 2020, we saw a bottoming in the economy. So we saw the recession ending, and we were moving into the first phase in the business cycle, that purple part of the chart there, the phase of rebuilding. When we got to 2021, we were starting to enter phase two, the phase of accelerating growth. And I think if there's one word, if you think about the economy in 2021 that gives you a good theme, it would be that word of acceleration. So as we move through the year, really rapid growth, we've kind of moved through that second phase, and as things stand today, we see us nearing the peak of the economic cycle. We're kind of moving into phase three, where you get slower economic growth, but growth that's still solid, coming off a pretty large base. I think this chart here really shows that idea of acceleration pretty poignantly. What you see here is real GDP growth going back the last 2 decades in the United States. On the right-hand side of that chart, you've got that big dip in 2020, right? That's the recession. And in the depths of that recession, we heard a lot of economists talking about what shape the recovery would look like, right? What would it be, a U and kind of a long slogging recovery? Would we get maybe a K where some industries would bounce back pretty quickly and then others maybe would take years to get back to normal? And this chart shows, I think, pretty clearly that what we had was a V-shaped recovery. I mean, we had a big acceleration off the bottom, and as we stand here today, real GDP growth is up near its pre-pandemic trend. When we look at markets in 2021, the key theme here is a wide dispersion of returns. That blue line there on the screen represents U.S. stocks, and it was a banner year for U.S. stocks. U.S. stocks were up about 28% last year. The green line represents international stocks. International stocks up about 8-9%. That looks like pretty poor performance on a relative basis when you compare it to the U.S., but historically that's about an average year. And 2021 was a really tough year for bond investors. Bonds had a return of negative 1.7%. That marks the 4th worst calendar year in the history of the bond market. So great year for stocks and a very, very tough year to be invested in fixed income in 2021. When you break down under the hood of the U.S. stock market, this theme of dispersion continues, right? What you see here is U.S. stock market performance last year, sector by sector. Last year marked the first time in 20 years that every sector in the S&P 500 had a double-digit return. Now, despite all that good news, you could see some did much better than others. And in fact, last year, some of the parts of the market that were hurt the most in 2020, things like energy, real estate, and financials, they bounced off the bottom and really led the charge in terms of market performance last year. I want to take a quick moment to look at what we said at the beginning of last year and how things played out, how it matched up with what actually happened. We thought there would be 3 big themes going into 2021. Continued economic recovery, we'd have low interest rates, and we would have inflation that would have some short-term inflationary pressure as markets started to open up. And I'd say all three of those broad themes really played themselves out. In terms of the markets, what we expected for financial markets, global stocks did better than we expected. We thought bonds would have a pretty muted year, but bonds disappointed us even further. But despite the poor return in bonds, stocks did so well that a regular 60-40 balanced middle-of-the-road portfolio actually did better than our expectations throughout the year. So overall, 2021 was a great year to be an investor. Can't talk about 2021 without talking about inflation. I mean, price increases have impacted all of us. They haven't been very fun. I mean, last year you had an inflation of 7%. That's the highest level in decades. And while that number is pretty eye-popping, we think it's really important to look under the hood of that inflation to get a sense for where inflation might go moving forward. And I think these two charts are pretty telling here. So last year you had consumers with lots of money, right, because they received government stimulus. At the same time they were receiving that money, for most of the year you had pretty strict lockdowns, so people were locked in their homes. And what ended up happening was they spent that money on physical goods. They bought stuff rather than spending it on services like going out to eat or traveling. And the chart on the left shows you this, I think, pretty well. Shows this shift in consumer demand. So the blue line on that chart represents demand for physical goods. Right? You see well above its pre-pandemic trend. The dashed line on that chart represents demand for services. So while demand for goods is way up, demand for services hasn't recovered from its pre-pandemic or to where it was pre-pandemic. Now, that combination of stimulus-induced demand and global supply chains that really had huge constraints on them because of the pandemic had a big impact on the price of goods. And you can see that in the chart on the right. So blue line there represents the price of goods. Dashed line represents the price of services. So price of services stayed pretty similar. As we reopen the economy, those dual forces hit each other. The price of goods spikes pretty dramatically. This is important because when we think about where inflation might go moving forward, we expect that change in consumer preferences to start to normalize. People starting to shift away from goods and back to services. And we expect some of the kinks in the global supply chain to sort of work themselves out as we move forward. It may take some time, but we think this big upward pressure on inflation that happened as we reopen the economy will start to abate a bit as we move forward. 2021 was a great year. Great year for the economy, great year for stock markets, but there were some risks that bubbled up throughout the course of the year that our team is really paying attention to, and we want to highlight two of them here for you today. So first risk is high levels of government debt. What you see on this chart, the blue bars on this chart represent the net increase in government debt, net debt to GDP in the United States on the left, the UK in the middle, and the Eurozone on the right, and that's over the last 2 decades. You see big spikes in net debt to GDP in the United States and the United Kingdom, right? And a pretty good sized spike in the Eurozone as well. The green bars on this chart represent the projected debt over the next 5 years, projected increase. So same thing. You can see big increases in the US, an increase in the UK, and it's actually projected to fall a little bit in the Eurozone. 2020 saw one of the most unique and deepest recessions any of us have seen in our lifetime. And government stimulus helped us through that. If you think about the pandemic and the recession that was associated with it as a canyon, government stimulus was really the bridge that got us over to the other side. But as we stand here today, these levels of government debt could potentially have negative impacts on economic growth moving forward, and it's a risk that we're watching very closely. The second risk we're taking a look at pretty closely is it kind of bubbled up in 2021, has to do with the size of the labor force and the growth of the labor force here in the United States. A growing labor force is a key economic component. A labor force that's growing at a healthy rate tends to be a good thing for the economy. A labor force that's growing very slowly or is very stagnant tends to be a negative for the economy. These three charts are something we're watching closely in terms of labor force growth here in the US. So the chart on the left represents the employment rate of people over the age of 55. And you can see on that right-hand side of that chart, that's where you hit the pandemic, you get this big drop-off in people leaving the labor force in later portions of their career. The middle chart shows you legal immigration in the United States over the last 20 years. Immigration is a key component of labor force growth, and you see the same thing in 2020, 2021, big drop-off in the level of legal immigration. And the chart on the right shows you global school closures and reopenings. And one of the unfortunate things about the last year is when schools closed, a lot of parents unfortunately had to leave the labor force. Well, most economists expected them to flood back in once schools started reopening. That hasn't been as much of a flood, it's been more like a trickle. So that combo of workers over 55 leaving the labor force, low levels of immigration, and parents who aren't returning back to work as quickly as we thought they might, that could have negative implications for the growth of the labor force, which would have negative implications for economic growth, and it could potentially push up wages, which would push up inflation. So the two big risks that we're watching are government debt, and we're watching keenly what the labor force growth looks like. In summary, 2021 was a year where we had plenty of negative headlines, but it was a year that investors were rewarded for staying the course. We think given the positive economic backdrop that we're seeing today, 2022 will be much of the same. So, thank you again, and I'd like to now pass it over to my colleague, Troy Dayton, who will talk about our extended macro outlook and give some of the opportunities we're seeing over the next 3 to 5 years.
Thank you, Steve, and hello, everyone. So I'd like to spend a few minutes and give you our 3 to 5 year economic outlook. And with that, I will touch on global economic growth. I will touch on what we're seeing from a demographic perspective, and also touch on market performance and valuations. And a lot of it will springboard off of what Steve Mahan just shared with you. So when we think about economic growth going forward, you have to take into consideration what central governments have done around the world in terms of the stimulus that they've provided, and also look forward to what interest rates, the direction of interest rates will look like. This chart here shows the dark blue line, and what's spiking up here is what happened to our US markets. So the US Federal Reserve, with the onset of the coronavirus, injected a bunch of capital into our market. And you can see that large spike up there. You can also see markets, the Eurozone and Japan. Eurozone is in the light blue, and Japan is the red line. They also provided monetary stimulus in 2020 with the coronavirus, but it paled in comparison to that of what we did here in the United States. Now, this is important because with financial stimulation, or an injection of capital into our markets with low interest rates, that spurs economic growth. Whereas rising interest rates and the absence of a monetary injection, or even taking capital out of the market, is designed to go ahead and slow down economic growth. So this is very important in what we saw during the height of the crisis. Now, as the Federal Reserve injected this massive amount of capital into our markets, it also attracted foreign investors to our markets. Here you can see in the light blue line are foreign assets coming into the US market. Now, this is important because it's helped prop up our markets over the last couple of years. Now, with the Federal Reserve injecting the capital that they have, it has propelled, it's boosted our economy and kept the economic machine running, and which has been very important as we've gone through this crisis period. Now, when we think about going forward, the Federal Reserve, they acted quickly. They went to a very large degree with this capital injection, and one of the concerns is that what we're all dealing with today, and that is inflationary pressures. And with the Federal Reserve now aware of this and talking about raising rates going forward, it's important to look at where we've been. This is the Fed funds rate over the last 50 years, since 1955. And we are currently at historically low levels. And with the Federal Reserve indicating that they're going to begin to raise rates this year, the market's anticipating about 4 rate increases this year for a total of a 1% increase. Now, looking at this chart, we're at historically low levels. Even a 1% increase still means we're near historically low levels. However, increasing rates are designed to slow economic growth. So we anticipate slower economic growth. We don't see this in other markets around the world. Excuse me. In fact, other major markets around the world. In fact, when you look at other central banks, they are still in a very accommodative mode. They're either maintaining that stance, or you've got economies that are moving to an accommodative stance. If you think about the Eurozone, they're nowhere near a position where they're going to start raising rates. Their economic growth is still below that was seen before the crisis. If you look at Japan, they're in a near zero inflationary environment. There's no need for them to raise rates. In the UK, where I used to work, they have modest inflationary pressures right now outside of energy and food. And then just last week, economic data out of China suggests that the consumer in China is struggling. In fact, the central bank in China moved to reverse restrictive actions they took last year by cutting 2 key interest rates in an effort to help boost the Chinese consumer. So when we tie all of that together, we see from an economic growth standpoint, the US with rising interest rates, this market's going to be slowing, but we'll go ahead and stay above our long-term average rates. In the Eurozone, we believe that we're going to see, we're going to see economic growth that's going to be faster than the US because they still have accommodative measures in place. They have an 800 billion euro recovery fund at their disposal. And last year, we saw a dramatic fall off in consumer spending such that, and that was actually at the same time that you saw incomes remain stable to actually increase. So they now have a massive level of savings that are going to support their growth. And then in China, we expect the Chinese economy to resume growth above the world average because you have reversing of restrictive policies and protocols, but you also have some natural disasters that weighed on their economic growth last year, such as, some natural disasters and also so the energy outages that they had. So we'll be anniversarying those and they'll resume growth. So if we think back to that chart where we saw foreign assets flow into the US market, when you take the backdrop that I just shared of rising interest rates in the US and slowing growth, yet economic growth overseas and accommodative measures, we see more attractive opportunities over in the international markets. Now, if we think about demographics for a minute, this is something that we've talked about at these Outlook meetings for the last couple of years. And looking at the working age demographics of emerging markets, that's represented in this light blue line here. And you can see that it's growing far in excess of that of developed markets, which is the dark blue line at the bottom, which when I first looked at this chart, I mistook that for the x-axis because it's so flat. But you can see tremendous growth here, and this is important because as you have a growing, young, and working population, that helps fuel greater manpower productivity and economic growth going forward. Another important component is the middle class. What does the health of the middle class look like? And the middle class in the United States, we understand, is struggling. When we look overseas at certain emerging markets, they're actually projected to grow quite healthily. So if we look at the blue bars here, that's the portion of the middle class represented in that country's population. And the blue chart is what it was in 1995. The green bars are what is expected in 2030. So you can see tremendous middle class growth in the likes of India, China, Brazil, and elsewhere. Again, that's important. With an increasing working class, that's going to drive an improvement or increases in the middle class, and that will drive consumption higher and strong economic growth for years to come. Now let me turn attention to the market performance and valuation over the last few years. This is a busy chart. I'm gonna repeat myself here. This here looks at international stocks relative to US stocks, and it's their cumulative outperformance relative to each other over the last 50 years. That's a mouthful, so I'll say that one more time. This is international stocks versus US stocks, their cumulative outperformance relative to each other over the last 50 years. If you look at the gray bars here, all the way right through there, this is when the U.S. stock market is outperforming international markets. And it's vice versa when the bars are purple. So beginning in 2009, you can begin to see the U.S. market began to outperform. But what you can also see in this chart is it's had an unprecedented level of outperformance. It's now spanning over 14.1 years in length. The prior historical duration was 6.2 years. So that's almost 2.5 times greater longevity for the U.S. market to outperform international markets recently. Now, the other thing is that the cumulative level of outperformance is something that we haven't seen in 50 years. Now turning to valuations. This looks at international stocks relative to U.S. stocks using the commonly accepted price to earnings ratio. The chart here, international stocks, they had a brief period where they traded at a premium relative to U.S. stocks. But since that time, they've become increasingly cheaper, such that today they trade at a 33% discount to U.S. stocks. That's the greatest discount we've seen in 20 years. And then a similar dynamic holds when you look at value stocks versus growth stocks. So value stocks, think of like financials, Bank of America, for instance, versus growth stocks such as your technology companies, as in Apple. Value stocks trade at a much more attractive level than growth stocks. They're trading at a 28% discount to growth stocks, which again is the greatest discount we've seen in the last 25 years. And similar, when you look at small cap stocks compared to the overall market. Small caps are trading at their greatest discount over the last 12 years. So what you've seen in your portfolios, almost gave that one away. What you've seen in your portfolios over the last 1.5 years is you've seen incremental changes from U.S. domiciled companies to international. You've seen from growth to value, and you've seen, again, incremental changes from larger cap companies to your medium-sized and small cap companies. Now, one other consideration are dividend payers. Our investment philosophy is one that's designed to focus on high-quality companies with improving cash flows that are trading at attractive valuations, whereby management teams are rewarding us shareholders. And one of the ways that they reward us shareholders is through a dividend payment. Dividend payments over time have shown to be a big component of your overall return. But also, dividend payers, those stocks appreciate at a much higher rate than non-dividend payers. So if you've had enough time to study this chart, that's great, but there's a lot of detail here. What I want to point your attention to is the red line here. First of all, this is work done by Ned Davis Research, and they go back to 1981 with this study. The red line represents the dividend payers, and this dark line represents non-dividend payers. And you can see dividend-paying stocks appreciated almost 13.4% on average per year, whereas the non-dividend-paying stocks, they appreciate about 9.7% on average per year. That's almost a 4% difference. And when you think about the long-term investment horizon of your portfolios, that's a meaningful difference and has a big impact on overall returns. So, in summary, when we look at the economic situation here in the U.S. versus international markets, we see slowing growth in the U.S. relative to international markets. We see more attractive valuations overseas than we see here in the U.S. market. And we see value more attractive than growth, small and medium-sized companies more attractive than your larger cap companies. And so you should expect in your portfolio continued small incremental changes that tilt your equity portfolio in this direction. Now, there's a lot that I've shared. Those are broad themes that we see over the next couple of years playing out. I'm going to go ahead and invite Sarah LeClaire, our portfolio manager, up on stage here. You guys are in for a great treat. I've had the pleasure of working with Sarah, and I think she's super intelligent and bright, and she's got a lot of great information to share with you guys today. So I'll invite her up. Thank you.
Up until now, we've gotten some good perspective on where we were last year, how we got to where we are today, and then also gained some perspective into some of our longer term outlook that we have on the years ahead or in those horizon years. At this point, I'd like to kind of bring us back to current times and highlight just some specific things that we're thinking about in this calendar year up ahead here. So I will say that when we think about financial markets, there is certainly no shortage of risk and opportunities for us all to consider. We're not going to share all of them with you today because we would be here for a long time. But we're going to highlight just a couple of them together, and then I'm also going to share some additional insights with you on the direction that we're taking our portfolios. So if we look to the year ahead specifically, for global markets, we do expect to see that continued economic recovery into the year and even beyond that a little bit, as well as some continued improvements within our supply chains. We do expect that COVID variants will have less severe impacts on the economy moving forward, and it's easy to look back now and say that while the pandemic certainly had an impact on the year, it certainly did not change the long-term trajectory that we have in the underlying fundamental markets. And at this point in time, our belief is that tax rates are likely to stay the same for 2022 as well. This year, we think that inflation will actually peak and may do so soon. I'm sure we're all very grateful for that when we think about our food and gas prices that we've been paying. As some of those temporary disruptions within our supply chains continue to ease and work through, some of the costs that we've been experiencing will begin to draw back, but some of those increases in expenses are likely to stay here as well. Geopolitical risks are likely to continue this year as well, and that could be in the form of international policy with some of the trade agreements, and even just as general tensions between nations remain. But all that being said, overall, we really do expect a positive year for the markets. It's just likely to be a little bit bumpier of a ride along the way. Now you'll see here that we do provide an expected range of returns for our portfolios, for a balanced portfolio for the year ahead, but we are going to dive in a bit deeper to this a little bit later, so we'll come back to that. So if we take time to look at specifically stocks and bonds, or those equities and fixed income, we're going to highlight, similar to how we have all along, just a couple of different risks and opportunities that our team are thinking about. So if we first turn our attention to global equities or stocks, you can see that our 2022 outlook is actually to be risk on in equities. We do believe that the long-term secular bull market that we've been in is going to continue through the year, but that navigation of it is really going to become key. It's almost as like if you're sitting in traffic and you can see exactly where you want to go and you know that you can get there, but you're in a lane that just has some more traffic than others. You kind of have to stop, slow down a little bit, shift over a lane to be able to proceed ahead. That's likely what this year is going to look like for us. As we heard Troy talk about just a moment ago, there are some really attractive valuations in the international markets. And as we've been doing research as a team together, we're seeing more and more investment opportunities overseas outside of the United States than we are within. It's not to say that we don't find opportunities here in the United States too, we just happen to be seeing a few more out there. Now, last year, we did highlight that the pandemic provided us a wonderful launch pad for innovation and technology growth. And we do think that the momentum of that is really going to carry through to this year as well. In healthcare, that might look like delivering more personalized medicine to people. Semiconductors are in everything we use now, and seemingly more and more things every day. They're becoming smaller in size and even more powerful too. In AI and digitization, there's a lot of innovation that's providing firms a great deal of productivity, which is helping them be able to expand their abilities. And we're even beginning to get a sense for what the metaverse looks like from Facebook. It's still hard to believe what that is, but we're getting a glimpse of that. Now, stocks certainly face some headwinds in the year ahead. If we think specifically about US stocks, they have seen a great deal of margin expansion over the last couple of years. And by that, by profit margin expansion, we mean the profitability and earnings of companies have really reached record high levels. Now, as inflation, supply chain challenges, those labor cost increases we talked about, and other challenges continue to put pressure on companies, that's going to put pressure on those profit margins, and they're likely to start coming down and revert more to a more normalized level. In addition, we do feel that we're going to see some increased volatility in the year ahead. As we started 2022, we started at a much higher level of valuations in the marketplace than normal. And when that happens, equities tend to be much more vulnerable to that volatility or the price movements up and down in the marketplace. So we do see that as a headwind. All that being said, though, we still do maintain a risk-on perspective for equities this year. If we shift our attention to fixed income or bonds, you'll see that contrary to equities, we actually hold a risk-off stance in fixed income this year. Some of the main risks facing investors this year are going to be negative real returns. And by real returns, I mean the interest rate that you're earning on fixed income minus the rate of inflation, which, as we saw earlier, is 7%. And if you know a bond that's paying 7%, I would love to know. In addition, we're coming into that rising interest rate environment, and both of those are really going to start to put pressure on fixed income. There are opportunities, however, that can still be found within the landscape of bonds. One of those is going to be to take a lower duration position in comparison to the broader bond market, and also taking advantage of those more frequent reinvestments of capital as the maturities, as the bonds mature. Now, 2022, on top of all of this, also happens to be a midterm election year. This chart does a great job of showing us, the colors don't stand out great, so I apologize, but the bottom line here is if we look back at an average of all of the different midterm election years over time versus a black year of all the other market years, you'll see that in midterm election years particularly, there's a lot of volatility or those movements, and it's pretty modest in terms of return through the beginning of the year until we can get to the fall, and that's where most of the returns come for the marketplace at that time. Now remember, the markets do not like uncertainty. We like to know where we're headed, and we like to know how we're going to get there. And in the beginning part of the year, there's some type of uncertainty, or there's not a lot of clarity when it comes to the outcome or what's going to happen in terms of the elections, wherever they stand, good, bad, or otherwise. So as we progress through the year and get closer and closer to that fall timeframe, we tend to get a little bit more understanding of where we may be headed or what policies may be, and so there we can plan a little bit better for that, and that's why you see the prices start to increase. Okay. So this chart here is actually a chart of the VIX, which is a measure of the expected volatility in the markets forward-looking. And this chart actually goes all the way back to 1990. And if you can imagine just putting like a ruler through the middle of it, you can tend to define what a midpoint line might look like or what the average might look like. If we zoom into just like the last 10, wrong button. This last 10-year period right here, you can see that we really haven't experienced an average level of volatility. It's just kind of been fairly muted along times. Now, there are certain periods where you get those spikes in volatility as represented. You have one period here, one period here. Those are the times where you kind of get that pit in your stomach, like you're sitting on a roller coaster and you're about to either go up a steep climb or down a steep drop, where there's just a little bit of uncomfort in the markets. We've certainly had sometimes periods like that, but over the last decade or so, we really haven't experienced any type of volatility. Now, when we start this calendar year too, 22% of the US market cap is concentrated in just 6 companies. Just 6, which is an incredible feat. And all 6 of those companies are also trading at much higher valuations than they normally do. This, coupled with that secular shift between growth to value and from large cap names into the small cap companies that Troy was talking about earlier, lead us to believe that we're just going to experience some higher volatility than normal in the markets this year. Okay. Now, as we saw, inflation really peaked in 2021, as we all experienced. But that doesn't mean that necessarily, it doesn't mean that it translates into negative returns for stocks and bonds unless it's persistent at those tail ends. So the tail ends in this picture would be anything below 0 or 6% or above. Now, the companies that have the greatest pricing power in these time periods are really the ones who are going to come through this really well because they can pass their increased cost along to consumers. Now, when we think about inflation, we can think about it in actually one of 2 ways. One is being sticky, meaning it's probably going to be around for a while. It's a little bit longer term in nature. That inflation tends to show up in areas like rent increases, or maybe insurance policy renewal rates, something that has a commitment of time to it. The other way to think about inflation is being more flexible. And flexible inflation is that shorter term inflation that shows up in like gas prices and food prices, like we talked about earlier. Now, as I said, the companies that really thrive in this environment have pricing power. They can be nimble to the cost. They can pass and adjust to the upside and the downside to consumers. And we think companies like those in luxury goods, maybe like household brand names that you would just commonly buy ongoing. Semiconductors can actually experience this. And certain areas of healthcare too, those types of companies are going to do well in this period. Now, inflation rates and interest rates actually have an inverse relationship to each other. When inflation, so the Federal Reserve sets the federal funds rates as a way to adjust the rate of inflation in the economy. And it's a way for them to be able to control the money supply, as we saw earlier. Now, because our interest rates have been staying really low for a long time, that's usually when we see inflation start to rise in the marketplace, and which is the environment that we've been living in. To the contrary, when interest rates are kept really high, you'll see inflation start to decrease. So that's one of the reasons that we also believe there's going to be some interest rate increases in the year ahead. Now, similar to inflation and interest rates having an inverse relationship, so do interest rates and bond prices. Now, we have the US bonds here represented by the US aggregate, which is going to be a combination of government bonds, corporate bonds, securitized bonds. And we spoke earlier about anticipating an increase in interest rates this year. For a 1% increase in rates, right now the market is pricing that bonds would lose just over 5% in market value. Now, earlier, I talked about one of the opportunities in fixed income being that it's beneficial to have a lower duration than the marketplace. Now, I'm going to try to do this one with one hand, but if we think of this little clicker as a midpoint in the marketplace, if we have on this side a 1% change in price or 1% change in rates, you'll see how much the clicker moves on the other side. We can almost use that as an example of the broad-based market. If we were to shorten duration and have the same movement, you could see that on this side, we have much less of a price change. So that's how we're going to want to position our portfolios in the year ahead. So with all that being said and everything that you've heard today, we get to the grand finale of why you're all here. So this is our 2022 outlook. Now, you will see that we've provided, again, those expected ranges for the calendar year. And we've done that by providing it for global equities, for fixed income, and also for a balanced portfolio. So for global equities, we are anticipating that for 2022, we can see a range of returns somewhere between 6 to 14%. Now, based on Troy's insights that he shared earlier, some of the things we've talked about today, we think that the international to small to mid-cap companies may lie at the higher end of that range for returns, whereas US stocks may lie near the lower end of that range. Now for fixed income, we are projecting that we should see a total return somewhere between -3 to -1%. This is because we have a lower duration in our portfolios than the broad-based market, and also we're getting that dividend payment still, so that helps when we look at a total return. So bringing those two together, tying them, you may be actually asking yourself right now, why do we even own bonds if we're expecting a negative return in the year? You know that saying, whenever you start to get stock recommendations from your Uber driver, your taxi driver, you should probably start waving the flag of caution. In times like this, when you start hearing a lot of people say, maybe you don't want to own bonds right now, that's probably when you should be maintaining an allocation to fixed income within your portfolios. So if we think about bonds traditionally, they have far less magnitude of price returns to the upside and the downside than stocks do. And in fact, they actually are considered non-correlated assets, meaning they move in opposite directions. In addition to that, fixed income acts as a ballast for our portfolio and gives us that sense of comfort or that sleep at night factor that makes us all feel a little bit better during really volatile times in the market. And if we're expecting really volatile times, it's natural that we'll want to keep an allocation to fixed income within our portfolios. One other piece you might notice is that we have a balanced portfolio listed as 65% equities and 35% fixed income. Now that probably looks a lot different to you than what you may traditionally think of in terms of a 50-50 or a 60-40 portfolio. Now, every client situation is going to be unique to yourself, so it doesn't mean that this will necessarily be your specific allocation. But as a team, this blend of equities and fixed income is comfortable to us when we think about the world ahead that we're facing both this year and in years to come. I wanted to show you an example of what this means because arriving at a 65-35% allocation just doesn't happen overnight. We're not going to flip the switch and instantly get there tomorrow now that we've all shared with you our thoughts on the year. This is something that we have been incrementally working towards over the last couple of years, ever since we came out of that COVID recession in early 2020. This chart here is actually a client account who has an allocation that's very representative of our strategy and our balanced portfolios. Now, if you think of this as a cup filling all the way up to 100%, each of the different colors is going to represent a different asset class that we've been talking about today. So the blue section on top is going to be representative of our equity allocation, and the dark gray in the middle, near kind of the bottom end, is our fixed income allocation. You will see right here in the middle, this is right about when that COVID recession hit. So we increased our fixed income allocation during the times of that market stress, or the times where we all woke up with that feeling like we were on a roller coaster in the morning. And incrementally, ever since then, we have been making very small adjustments and letting our fixed income allocation drift down to the place that it is now. Now, when we talk about reinvestments, we haven't been directly reinvesting in fixed income. That's what's allowed it to come down. But we've been making those purchases into areas that we feel that there's more longer term opportunity in the markets. So some of those are going to be the international companies that we talked about earlier. Sometimes it was into real estate. But in any case, each of those asset classes are actually paying a higher dividend right now than what we're earning in fixed income. So we certainly aren't losing sight of the income producing capabilities of our overall portfolio. So to close, I will say that we always encourage our clients to have an appropriate level of cash in their bank accounts outside of their investment accounts for when we have those times of emergency needs or for a cash reserve. It's really nice to be able to allow portfolios when we do hit times of market stress and time to recover and then replenish cash savings when it's maybe more favorable to do so in the marketplace once the breather has come out. If you haven't done so already, we really do encourage you to visit with your advisor to discover what that appropriate amount might be and either work to build it up for yourself or maybe consider investing in the excess. Because really, to close it all up, while there are headwinds in the marketplace right now, we really are optimistic about what's to come in the global markets, both in this year and in the years to come. So with that, I will invite Steve Nelson back up to join me. He's going to share some closing thoughts.
Thank you all. You can see why Susan and I are so proud of this team that's come together. We're very blessed to have a chance to work with these bright young people every day. It means the world to us that you all came. And we hope that the message was very clear. We like stocks. We don't like bonds so much. We like small mid-cap, and we like international stocks more than we probably like the U.S. stocks. But there's enough potential headwinds that we still think you need to have a balanced portfolio for most of you, for most of our clients. Having a diversified portfolio is going to make some sense because it could well be a bumpy year, even though we expect by the end of the year things will look a little better. So that's my very quick recap of everything you've just heard. I told you how proud we are of this great team that we have, and one of the qualities that we look for in our people is a desire to continuously improve. You know, in the marketplace, we're competing against the brightest people in the world, all over the world, and we're competing about money. So we better be pretty good. And one of the things that I really like about our team is that they embrace continuing education and professional development. This year, we wanted to celebrate with you three of our three students from the past year. First here, Steve Mahan completed the Chartered Financial Analyst designation. Congratulations, Steve. And Fallon Green completed the Financial Paraplanner Qualified Professional designation. She's the first paraplanner we've ever had at the firm. We're very excited. Yep. Congratulations, Fallon. And Sarah LeClaire completed level 2 of the CFA exam. And please, everyone, cross your fingers, say a prayer. We're waiting for the results from level 3 as well, and we should get those in a couple of weeks, I think. So hopefully, Sarah will be done with level 3. Thank you. Appreciate it. But those are all big accomplishments, and we really did want to celebrate them. It is very important that the team continue to learn and grow and improve and try and stay abreast of developments in the profession. So congratulations to all three of you for achieving that. You know, over 25 years ago, Chrissy and I came to Arizona. And as a chartered financial analyst, I went to one of the lunches. And at the end of the presentation by this CEO, he took questions. And there was this portfolio manager in the back of the room who asked a very insightful question. And it got my attention because I thought, now this is an analyst who really has some keen insight. And that portfolio manager, that analyst, was Keith Weibel. So I was impressed with Keith more than 25 years ago. And in all these years since, as peer professionals, as two CFAs and someone that I've known in the investment community, I've become even more impressed with Keith. And now for the last year and 9 months, I've had the chance to work every day alongside of Keith Weibel. And I can tell you, he is an insightful portfolio manager. He's a great analyst. I know he and Debbie are dear to many, many of you in the room. We are fortunate that Keith is going to remain with the firm and not retire until April 30th. But we thought this might be the biggest gathering we have in one place of a lot of Keith's clients from Foothills Asset Management. So one of the things we wanted to do was, before we sent him off to retirement, we wanted to do it in style. And as they're working their way around the room, we're going to have a toast to you in a minute, Keith. But if you want to make your way up this way, we'll maybe let you say a few comments, and then we'll offer a toast in your honor. So please welcome Keith Weibel.
Thank you, Steve, and thanks to all of you who have come out today, those that we've been privileged to work with for, more than 25 years, more than a quarter of a century at Foothills Asset Management. Nobody does this alone. I was blessed to have a wife who, back in 1995, believed in me and believed in the idea of an investment advisory firm and the vision that I had. That was our second most important accomplishment. Our most important accomplishment was 2 children who have a great work ethic, a strong moral compass, and they're kind and generous. And we're lucky enough today to have one of them here. David, I won't ask you to stand up and embarrass you. But the thing that made the decision to combine forces with Capital Insight Partners revolved much around very similar investment processes, but also very much around culture and character. And I want to share with you one quick anecdote that some of you have heard, others perhaps haven't. In the very early days of Foothills Asset Management, I was meeting with the prototypical little old lady who had just signed her investment management agreement. I was very excited because I was the only one at the time about having a new client. And as she put down the pen after signing the agreement, she pulled her glasses down to the end of her nose and she looked over the top of them and just with blazing eyes, and she said, "Young man, if you lose all of my money, I'm going to come and live with you." Now, I love telling that story for 2 reasons. First of all, it captures the essence of the trust that people place in us. And at the same time, it captures the responsibility that we have to all of you for the trust that you've given us. And as we were looking at potential merger partners, one of the things, in fact, the thing that made Capital Insight Partners stand out to us is that Sarah, Craig, Steve, everybody on the team shares that same level of commitment to clients. And so when the time comes for me to walk out of the office the last time, I'll be very comfortable that you all are in great hands. So thank you very much.
Thank you, Keith. Appreciate it. That was very nice. Thank you. Well, that was wonderful. And I should also point out how wonderful it's been to have Debbie Downing with us. So Debbie, you have to stay, but Keith, you have to stay until April 30th. And then we wish you bon voyage and a wonderful, magnificent retirement, which is more than deserved after this wonderful career of serving people so very well. Here's to you.
Thank you.
And again, thank you all for coming today. It means the world to us. We hope that this was helpful. We'll stay as long as you wish and answer any questions. Again, many thanks. Congratulations, Keith.